morning, and welcome to the early session kickoff. My name is Tim Muller, and I'm president of martinwolf, M&A Advisors, and ITX. We're the exclusive, as Bobby had mentioned, M&A partners with Informatech to bring you the Channel Partners M&A Marketplace, tapping the proprietary database of over 65,000 buyers around the world seeking MSPs. I'm pleased to welcome you to the M&A Superstar panel. Before we meet our panelists, I'd like to talk a little bit about the M&A market and the importance of gaining clarity as many of you contemplate the sale of your MSP. Having founded and sold 3 technology businesses over the last 25 years, and now a decade as an M&A professional, I've learned that the importance of clarity from the perspective of all 3 sides of the table: buyer, seller, and now the middleman. Selling a business is time-consuming and requires careful consideration of one's financial objectives, your personal goals, the best interests of your employees and your customers, and the emotional impact of you as the owner-operator. Without clarity, the decision-making process becomes cloudy, leading to unfavorable outcomes. So from various vantage points, I see that this is a compass guiding one through the M&A process. It's crucial to have clear understanding of your motivations for selling, which will impact the outcome of the deal. Lack of clarity can bring nothing but bad stuff. It leads to disagreements among stakeholders, shareholders, confusion about valuation, and delays in closing the deal. We live this daily. Selling your MSP can also be a very emotional decision. It's often difficult to let go of something that you've worked really hard and built that represents a significant part of your identity. Clarity helps manage the emotional impact and ensures you're making the decisions on your best behalf as well as everybody else that's affected by the deal. So to illustrate this point, imagine that you are climbing up a mountain that takes years and years to get to the top. You've worked hard to reach the summit, and now it's time to descend. Without a clear path, you'll wander aimlessly, unsure of which direction to take. However, with a map and a compass and maybe a really good iPhone, you'll navigate the descent with confidence knowing that you're on the right track. So to push the metaphor a little bit further, at your table are packets of these microfiber cloths. And if they're not at the table, they'll probably be passed out to you during the session or on your way out. Please take a look at them, because the microfiber material is the only cloth accepted by lens manufacturers to remove dust, to remove water, and whatever else disturbs the visibility through the lens or the surface of your electronic device. In other words, it provides clarity. And I personally keep these everywhere. I keep them in my car, I keep them in my backpack, in my office, just to make sure that I continue to have clarity in my glasses and things on that line. So turning to the M&A market, the M&A landscape for MSPs has been incredibly active. Many of you know because you're getting phone calls from guys like us on a regular basis. The volume upticked in 21 and continued through 2022. And despite economic headwinds that we have now in 23 with interest rates and such, we look back and say, coming off the momentum of 22 with 800 different transactions, they were divided pretty fairly between private equity, 45%, and strategic buyers were 55%. However, the MSP market, as it stands today, is very fragmented, creating opportunities for all buyers to consolidate and expand their services. Private equity-backed buyers, and you'll hear from Cheryl Strom from Riverside today, are looking to take the acquisitions they made in 21 and 22 and do add-on work today in 23. Offering a great exit opportunity for MSPs of all sizes. To talk about these opportunities, we have the pleasure of hearing from our 4 esteemed M&A experts on how to gain clarity before selling your business. The quality of this panel is such that they're impressive with extensive bios. Now, I don't know about you, but reading everyone's bio in full to you this morning would probably take longer than binging 5 seasons of Yellowstone, and then John Dutton saying, let's just get on with it. So our first panelist that we're introduced today will be Cristian Anastasiu, who is managing partner of Excendio Advisors. Prior to founding the M&A firm that he runs, Cristian was CEO of several technology companies ranging from Fortune 500 as well as middle market and startups. He's participated in more than 100 transactions with revenues ranging between 5 and 150 million. Welcome, Cristian.
Thank you.
Secondly, we have Neil Medwed, who is Vice President, Corporate Development and M&A for Meriplex.
Howdy, everybody.
You guys all know Neil. He's at many of these different conferences with us.
Good point.
And so Neil, after serving 26 years as CEO of Preferred Technology Solutions, a Texas-based MSP, he sold his business to Meriplex and today runs their M&A. Neil is responsible for the organization's national expansion and has led the acquisition of 10 MSPs in the last 2 years.
11 now.
11 now. So welcome, Neil. Our third panelist is Bradley Gross, the Counsel Law Office of Bradley Gross. Bradley is the founding partner and focuses on transactions involving MSPs, software development firms, solution providers, VARs, resellers, and IT services businesses worldwide. Welcome, Brad.
Good to be here.
And last but not least is Cheryl Strom, partner at the Riverside company. Cheryl leads the PE firm's deal origination throughout the Midwest. She and a team of 16 origination professionals in North America establish new platform companies and identify add-on acquisitions in the MSP space. And I know has a great perspective on the kind of targets that they go after and what they look for in an MSP. So welcome, panel, and let's get this thing started. Great. So, Cheryl, let's start with you. Looking through the lens of the private equity firms, what are Riverside's real high-level investment strategies? What types of MSPs are you looking for, and why?
Absolutely. So to give you a little background, the Riverside company has been investing in small, privately held businesses for 34 years. So we've really built our whole company for the business owners in this room for those occasions when they're looking for outside capital for any variety of reasons. As a firm, we do invest across 7 different industry specializations, and we're largely investing capital that is helping pension funds and retirement funds and large institutions achieve returns that can be, we're hoping, higher than they can if you invested in the public markets, because we're selecting small businesses that have a great growth ramp ahead of them. Our specialization in software and IT and tech-enabled business services is one of our largest specializations, and we have therefore acquired 12 MSPs over the past several years. The reasons we're attracted to that space is because of the recurring revenue, and we're largely seeking out companies that are generating revenue from a repetitive outsourced services. We understand the trend that small businesses, your customers very often need the same resources that a large enterprise experiences in the IT world, and it's only becoming more complicated. So we're looking for companies that are generating recurring revenue, that are run by someone today who wants to be a part of something bigger. So I'll tell you a very quick story of a new MSP we invested in earlier this year. It was founded by a CEO who started this company, a founder, in 2001. And by 2022, he'd built a very nice organization, but realized he wanted to do more and wanted access to additional capital to be a platform for making add-on acquisitions. We partnered with this founder who has invested significantly in the business while Riverside has become the majority investor and is backing that company with a $1.8 billion fund to create the capital for additional investment in this sector. Last, real quick, because you asked me, Tim, what we look for in terms of criteria, we are interested in all sizes. There's a myth out there that, my company has to have 25 million in revenue or 5 million in EBITDA to be interesting. There may be some private equity firms that have those criteria, but we will invest in companies with as little as 3 million in annual revenue, to the extent that that could become a new market presence for one of our existing portfolio companies. And we invest in companies up to 400 million in enterprise value.
Great, thanks, Cheryl. We'll jump over to our cowboy-wearing Neil, cowboy boots. As a strategic buyer, how is Meriplex approaching M&A transactions in today's market, and what factors are you prioritizing when making that acquisition?
Meriplex is building the nationally recognized, coast-to-coast, north-to-south, managed technology solution provider in the nation. Meriplex looks for quality MSPs with quality revenues, quality reoccurring revenue that's growing, and that has leadership that hopefully wants to do something much, much bigger and better than they could otherwise. Meriplex, we're one Meriplex. There's many different models, and many different models fit different types of organizations. But we are one Meriplex, and what Meriplex is building is extremely special. So when you look at what we're looking and what we're seeing, in the industry, there are a lot of high-quality MSPs in the nation that are growing, that are doing some really, really good things. And those are the types of companies that we, as Meriplex, look for. All the companies that are doing similar things are looking for the higher EBITDA numbers, looking for the higher revenue numbers, looking for a team, but also looking for an organization that the funnel's not the leader, the CEO, that has a quality leadership team across where they can really, with the right partner and the right company, really add a lot of value. So in the marketplace, there's a few different things that talking about today's new realities. I'm one of you. I sold my business less than 3 years ago and have gone into buying 11 companies since then. And one of the things I like to speak about is if I knew then what I know now. I would run my business so different than I did previously. So reach out to me at some point and let me share that with you. But build a quality company driving good EBITDA, and there'll be many people like us who would love to talk about the art of the future possible with you.
Without doing a commercial message for Meriplex, we've sold to you.
Yes, you have.
And I will tell you that they do what they say they're going to do. They held strong throughout the due diligence process, and they do get deals done. So it's really a pleasure doing deals with you.
Thank you.
So on to our legal beagle, Brad. You have a really unique perspective on things because you're getting different deals of different sizes all around the world, and your job really is to get it over the finish line.
Right.
So what are some of the more important legal issues owners should be aware of before they even go to market as they prepare for an exit?
All right. So, good morning, everyone. If you're going to prepare for an exit, my advice is prepare from day one. Prepare as if you are going to sell from day one. Now, I'm not saying that means on day one you think of a number, but you prepare as of day one. Think of this. If you get the call in year 10 or year 15 or year 20, and you have been thinking about preparing to sell from day one, you're going to be in a much better position. And what might that call sound like? Right? Think about that. From a legal perspective, right? I understand that we're going to look at my colleagues here will look at numbers and so forth. I get that. But from a legal perspective, what are we going to look at? What we're going to look at are things like your agreements. Are you running your business like a business from day one? Do you have the right agreements in place? Do you have agreements, right? Are things being done on a handshake? Because to everyone up here, things that are done on a handshake are worth squat. So you're going to run it like a business from day one. You're going to make sure your agreements are in order with your customers. We can talk more about that if you'd like. And the other thing that I think you really need to think about from day one, along with running your business like a business, is making sure your governing documents are in order. A business, you're an Inc., you're an LLC, right? You're a corporation. We're past the mom and pop stage. We're past the point where, you're a bunch of people that got together and wanted to do something big. Make sure you have your documents in order, right? This is not the time when my colleagues here step up to the line to do a deal. That's not the time to figure out tag-along rights, drag-along rights, whether, you have that one owner who's a holdout. That's not the time. It's too late. So prepare from day one.
You know, I think you make some great points there, Brad. We often tell people that are starting to prepare for an exit is to, on one side of the mouth, run your business as though you'll never sell it. So invest in that back end, invest in solid principles and core values, but then at the same time, run it as though you're always going to be for sale, so that your books are in order. So for due diligence, it's not, well, let's see, it's going to take me 3 weeks to get that one report to you. And I think all agree that the financial reporting gives you an idea of whether or not the owners have the finger on the pulse of their business, if they can get to the financials in a decent amount of time. So great points, Brad. So to my colleague to my left, Cristian, who, you know, again, when we talk about some of these deals, that's right in your sweet spot, that $5 to $150 million deal, which I think a lot of people in the audience represent that range.
Right.
So what role do the M&A advisors play in helping the MSPs prepare for a sale? And why is it important to work with an advisor versus kind of that for sale by owner, the FSBO approach of selling your business?
Sure. Thanks for the question, and I think that we can cover probably a couple of hours, but I like to break it down into two pieces and go first to the preparation, because we spoke quite a bit about that. And I'd like to answer your question by sharing a story. This was a couple of years ago. It was a cold, snowy day in the Midwest. We were at my client's office getting ready to sign a deal that took more than 1 year to get done. It was a deal with some complications, a lot of twists and turns, and a deal that probably died a couple of times during that year. It was a great strategic fit between the two companies, but the personalities of the sellers and buyers could not have been more different. Definitely not a match made in heaven, probably quite the opposite. So as we get ready to sell, the buyer addresses my client, who was sitting behind his desk, and says, listen, over the last couple of months, I've been at your office several times. I came to love your desk. And it was really a beautiful desk, the one you see in the movies, beautifully crafted. And he continued, I can't wait for Monday to come for me to sit at that desk. I'm going to enjoy every moment of it. Actually, I think I pictured myself behind that desk several times. He didn't finish the question. My client exclaimed, excuse me, I have this desk from my grandfather. And my grandfather has it from his father. This is a family treasure. I'm not selling it, and I will keep the desk. The buyer continued in a very calm voice, says, listen, the desk was part of the fixed asset list, which is part of the purchase agreement. We bought it, we paid for it, we keep it. And my client exclaimed again, then there's no deal. And it became quiet really fast. The next seconds felt like minutes. The minutes felt like hours. And I thought, is this what's going to kill the deal? A desk? And knowing my client, I thought he will actually kill the deal and keep the desk and keep the company. And fortunately, I think the buyer thought the same thing, because over the next 30 minutes, I was able to convince him to give up the desk. And we finally closed the deal, we signed, and everybody went home happy. So my point is, if you are an owner preparing to sell, or you're close to selling, what is your desk? In most cases, it's really not a material thing. In most cases, it's your relationship with your clients and your employees. It's the recognition you have among your peers for being a successful entrepreneur. It's the dreams, the passion, the future, the plans, the memories. What is that one thing that you will have a hard time let go of? And more importantly, how will you replace it? So I think knowing your desk is an important part of a preparation, in addition to a lot of other things like financials and knowing how to talk to buyers and knowing what to expect from buyers.
Great story. And you got the deal done, right?
It was closed. Everybody went happy just before the blizzard that came later that Friday.
What happened with the desk?
Stayed with my client.
Okay.
We convinced the buyer to give it up.
Okay.
Well, and you know, that's interesting, because that goes back to a little bit of the emotional separation that owner-operators have, whether it's 5 years or 25 years, and that business becomes their identity. And I think that is something that buyers need to be sensitive of as they look at what role they will play post-transaction. So Cheryl, what are some of the most effective ways for MSPs to really maximize their valuation? And also, what are some of the steps they could take to minimize the risk during due diligence?
Absolutely. So to maximize valuation, and before I get into those nuts and bolts, I just want to point out I entirely agree, Cristian, with everything you said. It's important, I think, before these due diligence and final stages to make sure that you admire and respect the buyer, and that you want to do business with them, that you feel passionate and comfortable. I actually spoke last night over the dart throwing session with a business owner who told me he's talked to a couple of buyers, but one of them made him feel he wouldn't be able to sleep at night if he did business with them and they moved on. I will say at my firm at Riverside, we've worked really hard to make sure that we care about the people and we only make promises that we can deliver on, which is one reason why sometimes we don't even issue LOIs till we're really have a really good understanding of the business and feel confident we can live up to it. So what data do we need to do that, and what will help meet our criteria? I'll just talk about 3 quick points. One, we want to see revenue rising, if at all possible, organic growth, and in the absence of revenue growth figure that is stellar, retention. Keeping those sticky recurring revenue customers, seeing a logo churn of really no more than about 10%. We want to see about 90% retention. And then also seeing a high mix, the sales mix of business in the recurring versus the one-time, and seeing gross margins. Typically, we're looking for gross margins of above 35% or so. So then how do you prepare and make sure that in due diligence everything stays where you want it to be, and that everyone shakes hands at the end? One word that you want to stay away from, it's an S word, and it's not the S in MSP, but it's the word surprise. But imagine there's a big X over the word surprise. You want to avoid surprises. And so that really takes running your business in such a way that there are systems and processes that help you to be able to articulate a forecast. And be able to understand if something is going to happen, like a customer might be lost that's real important to you. Don't hide that. It probably won't go away, and it's much less comfortable. That something can be worked out, but if the buyer feels that maybe they're not being told the truth, they may sort of knock you for risks in other areas where you don't necessarily deserve to see those risks. We're a seller ourselves of businesses. We're both a very active investor and buyer in businesses, and then about at the end of a 5 to 7 year period, we do need to exit and complete our investment. So we're always preparing to sell on day one, just like the advice that you had given Brad. And we have a little acronym called SPARKLE that we follow across our portfolio companies. And I don't have time to go through every single word of it, but the S means strong management team. My favorite R means rising revenue up and to the right. And the L stands for lots of data. So you might need help from someone like Tim Muller or Cristian to help you prepare that lots of data if it isn't a natural process in your business where you're constantly able to answer questions about different service lines, retention, margin by product, and the like. But if you can sparkle and avoid surprises, I think you'll have a successful experience.
Great advice, Cheryl. Really great. So, Neil, you talked about, if you knew then what you know now and how would you have done differently. What are some of the more common mistakes that MSPs make when moving toward a sale, and how can they avoid some of these pitfalls?
Sure. Number one is there's a difference, and please internalize this next comment. There's a difference between making money and creating wealth. Internalize that for a moment. When you're running a business, again, if I knew what I knew then, or not what I know now then, I would run Preferred Technology Solutions, totally differently. I would have managed much better through key performance indicators. I would have managed using my head more so, than my heart. I look at hundreds and thousands of different companies on my time doing what I'm doing over here. And I can look very, very quickly and closely and tell, are they overstaffed, for example? How sophisticated are they? Looking at an org chart, you can tell how they're set up as a business. So, number one, I'm a huge proponent of peer groups. a huge proponent of deep dive peer groups because you can learn how the financials. In our industry, you're more likely either a salesman that opened up an MSP or you're an engineer that said, hey, I can do it better, let me open up my own MSP. Very rarely are you a Harvard MBA or a finance guru that said, hey, I'm going to open up an MSP. So get that information, compare yourself to others in our industry who sit in the same seat as you, and right-size your business. If let's say you're a 20-person firm, and you have, let's say, 2 or 3 extra people, let's just make numbers easy, $100,000 all in. If you right-size your business, you can invest in better tools. You can give better bonuses. You can bring more to the bottom line, making you more valuable as a company. Whether you want to sell or not, it's a for-profit business. So look at financials. Make sure to right-size your company. Things like, Bradley, he's the master as far as agreements. And if you guys want advice, this guy's the dude to get it from. But things like, being able to assign, if you're sold, assigning the MSP agreements to a new buyer. We just did a month ago, bought a 140-person firm that it was delayed a month because they had to get all their customers to sign over that they could move the managed service agreements on forward. Stake your ground on managed services, managed security. Downplay the NRR, the non-reoccurring revenue. You'll probably create much more wealth by doing that. The peers you have next to you, make friends. Be able to talk to one another. Share information. Those are things that can help create the best business, create the most wealth. So whenever it does come a day when a Neil Medwed from Meriplex calls you, you're best prepared to do something much better.
And that's a great point. And we've done deals where, the market wasn't going to bear what the valuation of the seller wanted. So we went through several months and we just realized it wasn't time. Hit the pause button. And they then got that roadmap. They got the clarity of what they needed to do to come out another 18, 24 months later and truly hit the number that they needed. So none of it is a waste of time by any means.
Exactly.
So Brad, what advice would you give to these MSPs in the audience who are contemplating a sale during the next, let's say, 12 to 24 months from a legal and business preparedness perspective?
Okay, so you have a year or two to get ready, right? That's where you are. You need to make sure that you understand your business. So what do I mean by that? First, put your stake in the ground. Know what you want. Don't just toss your company out there and say, I don't know, what would you pay for me? Right? You need to know what you're worth. You need to know what your value is. Like Neil said, you need to know what your monthly recurring revenue is and your non-recurring revenue. You need to have an understanding. It's not a game, because if you are not sure of where you stand and what you want, you're going to be taken advantage of by a buyer. And by taking advantage of, I mean, you're not going to get the money that you maybe should get. Okay? So from my perspective, understand your value. That's first. Second, make sure that you understand your business. If I went around the room and said, what do your top 10 clients think of you? Think about that. What do your top 10 clients think about? Because I promise you, when it comes to a merger or an acquisition, your top 10 clients are going to get a call, right? How do you like working with this company? Do you even know what your customers think of you? Because if you don't, then you don't know your business. So think about it. If you don't have a stake in the ground, you don't really know what you're worth, and you don't know what your customers are, right, or what they like, then where are you? You're nowhere. So my 2 bits of advice right off the bat are, 1, understand your value. 2, understand your customers, because your customers are your business. Okay? Stay with those concepts. That's what I'm throwing out there for you.
Great. So, Cristian, without being a commercial message for your firm, because, right? But what are some of the most important factors MSPs should look for when they're selecting an M&A advisor? and what qualities should they look for in a potential partner when they're, when they've got many different buyers offering, a deal?
Sure. And let me go back to the second part of your first question, which was why should a business owner work with an advisor in the first place?
Sure.
And actually, I have another story I like to share. This story is about John. John was the owner of an IT services company. Actually, I met him in Vegas at an event many years ago. We spoke about mergers and acquisitions, and he told me, look, whenever I decide to sell, I'll talk to you and I'll hire you. And then one day I get a call from John, and he told me, Cristian, I just want to let you know, I signed an LOI, a letter of intent, with a buyer. As a matter of fact, you know the buyer. They told me they know you from prior transactions. I told them I know you. And the buyer recommended that I hire you. They said if Cristian is involved, the chances of a transaction closing are higher, and the chances of you getting what you want out of the deal increase as well. Be it as it may, John decided to not hire an advisor and move forward with the LOI. I wished him luck. A couple of months later, John called me again and said the deal fell through. He also told me he now understands the value an advisor can bring to a deal, and he still wants to sell the business and has decided to work with us. I said, excellent, really happy to hear. Let me send you our agreement. He says, hold on, there's one more thing. A couple of days ago, we received another LOI from a buyer that we know from the industry. It's not a great offer, but I would like you to include it in your process. I said, of course, no problem. We start the work. We develop the SIM, confidential information memorandum, start to send it out. And one of the first SIMs we'd send out is to John's buyer. I'm not making this up. Within 20 minutes of sending the SIM to the buyer called John directly, not me, thanked him for the document, and improved the offer by 20%, just over 20%, without being asked to. John was really happy. We continued the process, and a couple of weeks later, we had 3 very strong offers, all of them better than the offer from John's buyer. And goes without saying, we closed a really good deal for John. So we'll never know why the buyer improved the offer without being asked to. You can speculate it was maybe the SIM and the way the information was presented there, the opportunities, the strengths of the company. Probably it was the realization that John is now working with us, and as a result, there's going to be more buyers included in the process. There's going to be competition. But be it as it may, we closed a really good deal for John. So just to finish and summarize, because I think some of the points are included in the story, an advisor can bring buyers to the table that are not known. And in the lower middle market, a majority of the deals close with buyers that the seller did not know at the beginning of the process. An advisor can create a competitive environment, a competitive market for the company. There's a saying in M&A that a good deal must die 3 times before it closes. So an advisor can really bring creativity and bring good solutions to those problems, and can be a buffer between the buyer and the seller. And finally, as was mentioned in the story, and that's something that was not intuitive to me, but I learned in talking to buyers, majority of the buyers actually prefer to work with sellers who have representation, because they know that the seller is motivated and is prepared, as opposed to just curious.
That's great. All right, so we've got 5 minutes left. We're going to go to a lightning round. So 30 seconds each for some of these questions, and I think we'll finish up. Cheryl and Neil, what trends are you currently seeing that's driving M&A activity in the market, and how do these trends likely evolve in the future? Cheryl?
So we are seeing as private equity investors, I'm seeing all of my peers in the industry also do this, looking at bringing together groups of companies, and add-on acquisitions are a great focus for us. What does an add-on mean? It means joining forces with a larger company that already exists. It's particularly suited for business owners who are looking for a good home for their business, but don't necessarily see their business being a buyer of other companies itself. And that is a significant mix of private equity investments over the past 12 months have been add-on acquisitions as opposed to platforms. Platforms are also excellent. There's just a much higher bar for the fit.
Neil? Trends?
Trends in the industry. What we're seeing is, first of all, running an MSP is not for the faint of heart. there's cyber risks, there's employee risks, there's all these different risks that hit us as MSP owners each and every day. Back to the building wealth perspective, partnering up with Meriplex and becoming part of Meriplex many times can create much more wealth than you could running your own company. Partnering up with a company like Meriplex allows you to take a lot of chips off the table, have an equity stake in a much bigger pie, and again, the returns with less risk are much, much better. So trends in the industry, quality companies are still getting quality multiples. Not so well-run companies, the multiples are certainly dropping. And the reason why quality companies are still getting high multiples is because of the competition between Meriplex and others, for example. But if you're not a well-run company, if you don't have strong EBITDA, things like that, then the multiples of 2022 may not be there for you.
That's great. And finally, for Brad and Cristian, without naming names, tell us a story about a deal that went south because either it had to get redialed or something happened during a deal that caused the buyer to take pause and either give a different and lower price or they walked away altogether.
Sure. So, every story of a failed deal always comes down to one thing. And in my view, that thing is hubris. You think you know more than you do. You think you guys know more than Cheryl or Tim or Neil, Cristian? You don't. You don't, right? You have advisors. You got to use them. Don't think that because you've been in the business for 15 or 20 or 30 years, you understand your business, you understand how things go. No. You have advisors, use them. And every story that I can tell you about a deal that went south, about 10 to 15% I would say is probably where I'm seeing deals that should have gone forward and failed, about 10 to 15% of them, all have to do with a failure to listen to their advisors, a failure to understand business, exaggeration of your business, right? All of that stuff. We could take any MSP and any MSP that's looking to sell, and I could tell you a story about how that MSP exaggerated its business, thinking the advisors, these guys won't figure that out. Oh, they'll figure it out. Trust me, they'll figure it out. Or hubris. I know more than they do. Listen, this is the way I want the deal to be done, and this is how it's going to happen. Okay, now you're in the 10 to 15% failure, right? So my story, while not specific, sort of the moral of it that I'm telling everyone here is, you have advisors, you have these guys, you listen to them. Get rid of the hubris. Don't think that just because you've been in it for so long that you understand this side of things. You hire good people, listen to them.
Cristian, finish us off.
Sure, let's really short, and I agree some of the examples Brad gave. The list is probably long, unfortunately, but the one most common problem that occurs in a transaction is what I call it, and it's generally known as the hockey stick effect. There's business owners who've run their business for 10, 20 years, with 10 million, 20 million, certain profitability. The year they get ready to sell, projections are 20, 30, 40% high. In most cases, unfortunately, they don't materialize, and the implication is for buyers that they really don't know the business. Obviously, it's an exaggeration, but the implication is that they don't know the business. They're trying to maybe hide something that they don't disclose.
Mm. And I'll finish off by saying that time is always the enemy of the deal. So the longer you take to get back to the buyers and the more you flinch, the chances are the deal is going to go south. So I want to thank everyone for the panel for this session today. I think most of us will be around this week if you want to talk to us about any part of deal making. But enjoy your week, and thanks for coming to the kickoff session.